Hi there, welcome to part one of our comprehensive guide on the 7 most popular business types in the United States. Choosing the right structure for your company is a crucial decision that can affect everything from liability to taxes. Today, we'll break down each business type, examining their pros, cons, and ideal use cases. Let's get started. Section 1, Sole Proprietorship. First on our list is the sole proprietorship, the simplest and most common business structure in the US. This is perfect for solo entrepreneurs who want full control over their business. Pros include easy and inexpensive setup. Setting up a sole proprietorship is quick and straightforward, requiring minimal paperwork and fees. You can often start operating immediately without needing formal registration, making it ideal for small, low-risk businesses. Complete control. As the sole owner, you have total decision-making power over all aspects of the business. This autonomy allows you to implement your vision without the need for consensus or approval from others. Simple taxation. Tax reporting is simplified since business income is reported directly on your personal tax return. This pass-through taxation eliminates the need for separate corporate tax filings. But the structure also has cons. Unlimited personal liability. There's no distinction between personal and business assets, meaning you're personally liable for all business debts and legal obligations. This could put your personal property at risk if the business incurs significant liabilities. Difficulty raising capital. Investors are often hesitant to invest in sole proprietorships due to the lack of formal structure and limited growth potential. This can make it challenging to secure loans or attract outside investment. Limited continuity. The business doesn't have perpetual existence. It ceases to exist if the owner retires, sells the business, or passes away, which can disrupt continuity and succession planning. Section 2, Limited Liability Company, LLC. An LLC combines the flexibility of a partnership with the liability protection of a corporation, making it a very popular choice for small to medium-sized businesses. Pros include limited personal liability. Unlike sole proprietorships, an LLC protects your personal assets from business liabilities. This means that creditors can't pursue your personal property to satisfy business debts, providing a crucial layer of protection. Flexible management structure. LLCs can be managed by the owners, members, or by appointed managers, offering flexibility in how the business is run. This structure allows you to customize the management approach to fit your business needs. Taxation. Like a sole proprietorship, LLCs typically benefit from pass-through taxation, where profits and losses are reported on individual tax returns. This avoids the double taxation that corporations often face. Additionally, LLCs can elect different tax classifications to further optimize their tax burden. Versatility in ownership. An LLC can have one or multiple members, and there are no restrictions on who can be an owner, which offers flexibility in ownership and operational rules. However, there are cons to consider. Complex taxation. While LLCs enjoy pass-through taxation, the tax requirements can be more complex, especially if there are multiple members. You may need to file additional forms and keep detailed records to comply with IRS regulations. Potential for dissolution. The departure or death of a member can lead to the dissolution of the LLC, depending on state laws and the terms of the operating agreement. This can create instability if not carefully managed. Higher formation and compliance costs. Compared to a sole proprietorship, forming an LLC involves higher initial costs, including filing fees and possibly legal services. Additionally, LLCs must adhere to ongoing compliance requirements, such as annual reports and fees, which can add to operational expenses. Section 3, General Partnership. Now let's discuss general partnerships, which are ideal when you're teaming up with a trusted partner to start a business. In a general partnership, all partners share profits, losses, and management responsibilities. Pros include ease of formation. General partnerships are relatively easy to form, often requiring just a partnership agreement to outline each partner's responsibilities and profit-sharing arrangements. This simplicity makes it an accessible option for many entrepreneurs. Shared financial commitment. Partners can pool their resources, which increases the business's capital and borrowing potential. This shared investment can lead to greater financial strength and opportunities for growth. But there are significant cons. Unlimited personal liability. Each partner is personally liable for the business's debts, and this extends to liabilities incurred by other partners. If one partner mismanages the business or incurs debt, all partners are equally responsible. Potential for conflict. Shared management means that disagreements can arise, especially in decision-making. Without clear communication and a strong partnership agreement, conflicts can disrupt business operations. Limited continuity. The partnership may dissolve if one partner leaves, retires, or dies, unless otherwise agreed upon in a partnership agreement. This lack of continuity can create instability and uncertainty. Section 4, Limited Partnership or LP. A limited partnership, or LP, is another option where there's at least one general partner who manages the business and assumes unlimited liability, and one or more limited partners who contribute financially but have limited liability. Pros include limited liability for some partners. Limited partners are only liable up to the amount of their investment. This protection encourages investment by individuals who want to contribute capital without being involved in day-to-day management. Attracts investors. LPs are very attractive to investors who prefer to be passive participants, allowing the business to raise capital without giving up management control. This makes it easier to fund large projects or expand operations. Flexibility in taxation. Limited partnerships benefit from pass-through taxation, meaning that profits are only taxed at the individual level, avoiding double taxation. Additionally, there is flexibility in how profits and losses are allocated among partners. However, there are cons to be aware of. Unlimited liability for general partners. The general partner assumes full liability for the business's obligations. This includes both legal and financial risks, which can deter individuals from taking on this role. Complex formation and management. LPs require formal registration and often involve more complex documentation, such as partnership agreement and state filings. Additionally, managing an LP can be complicated, especially with multiple partners having different levels of involvement and liability. Limited availability. Not all states allow the formation of limited partnerships, which can restrict where you can operate. It's essential to check state-specific regulations before deciding on the structure. Conclusion. Choosing the right business structure is a crucial decision that should align with your business goals, risk tolerance, and operational preferences. Consider the level of liability protection you need, the complexity of management, and your long-term vision for the company. In Part 2, we will cover corporations, nonprofit organizations, and cooperatives. As always, thanks for watching. For a more in-depth overview on the topic, head over to the article in the video description. And as always, if you found the video helpful, we would appreciate it if you liked the video and subscribe for similar content in the future. Also, don't forget to visit SimplifyLLC.com for more business-related guides. We'll see you soon.